Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, Caroline Hyde, Taylor Briggs counting you down to the closing bells. Here to help take us beyond the bell. It's our global simulcast, joined right now by Tim Stenovec and Mike Regan. In for Carol Master. We welcome our audiences across Bloomberg Television, Radio, and YouTube on a day here, Tim, where we're looking at an S&P 500 down about 4% here on the day. One of the worst sell-offs that we've seen since June of 2020. And as for the NASDAQ 100, the worst sell-off that we've seen going back to March of 2020.
Yeah, quite a few superlatives, and especially when you talk about those, COVID lockdown moments, it really speaks to the volume of today. We just spoke to Carol Schleif, Deputy Chief Investment Officer at BMO Family Office, and she put some real perspective on this. She said, down days like this are scary, but I saw 1987, and that was a more than 20% decline. Anytime you go back and reference 1987, for context, it's an ugly day.
Yeah, Tim, and one thing I keep thinking about is a lot of investors like to see that quote-unquote capitulation where investors just sell everything. And boy, if this doesn't quite look like that. I mean, I'm looking at the NASDAQ 100, Taylor, only one stock up. Whoop, not anymore. No stocks up in the NASDAQ 100. Only 5 stocks up in the S&P 500. So, Taylor, really, it's just sell everything day. And, if I had to put my optimist hat on, maybe this is something like that capitulation that investors like to see as a sign that it's time to get back in and buy.
Across asset, you're seeing CDX, of course, the cost of protecting against the downside, against sort of that default within high yield. That rises the most in about 2 years. You are seeing some concerns maybe within the high yield market, but certainly not sort of on a long-term trend, a big widening of some of these major spreads within the risky assets.
Positioning in this market had still been decidedly bearish. Maybe the last 4 days were an anomaly. Maybe today is the anomaly. Whether you think it is or not, it was an awful day. The Dow Jones Industrial Average losing 1,300 points here on the day, down 4%. The S&P 500 down about 178 points. 4% loss on the day. The NASDAQ Composite down 632 points, or about 5.2%. The NASDAQ 100, which we should point out, is down 5.5%, and the Russell 2000, Tim, down about 3.9% here on the day, right now at 1831.
Yeah, to Mike's point earlier about a sell everything day, the idea of capitulation perhaps. 6%, make that 5 as we get settled here. Only 5 stocks in the S&P 500 were in the green today. 497 were in the red.
You really see that. Some of the big decliners there, the size and scope, Tim, of course, that you provide. We'll also try to provide some size and scope as well when you think about some of the individual sectors as well for the S&P 500. And again, there's not even one sector in the green. For our radio audience, we'll put this out on Twitter for you. Even the best performers, they're still off 2.5%. The sector that outperformed energy lost 2.5% today. That really tells you the pressure that this market was under. Household products and utilities, classic safe havens also, Mike, as you know this, off 2.7%. Unfortunately, we'll go to the bottom of the screen as well. As Caroline says, if you're long this market, the worst performers here were a lot of the red. Technology, software, media, semiconductors, you're off 5 to even 6.7% on the day.
Well, Taylor, let me tell you about what actually did manage to gain today. There's not many of them. I could pretty much rattle off all the stocks that gained in the S&P 500. The biggest gainer, Corteva, which is a agriscience company, up about less than 0.9%. They announced a $2 billion buyback. Twitter up about 0.8%. This is after shareholders approved Elon Musk's $44 billion buyout. Of course, that's still about 38% higher than where the shares are trading. And Romaine, this one's for you. I know you're worried about your big load of butter being delivered on time. There's also concern about fertilizer being delivered, and they're already halting shipments of ammonia, a key component of fertilizer, because of the potential rail strike. Well, CF Industries shareholders actually like that news for some reason. That stock is up 0.7%.
All right, you got the gainers, Mike. Lucky to find a few of those. I got the decliners. It was pretty easy to do this today. I want to start with the biggest decliner on a percentage basis in the S&P 500 today. That would be Eastman Chemical. Actually fallen the most since June of 2020 at levels last seen in November of 2020. The company guided toward lower than expected third quarter results. The CEO said the demand has, quote, slowed more than expected in August and September. Analysts have been slashing price targets and ratings in the sector as sentiment continues to worsen. Citigroup actually performed better better than the S&P 500 today, but I still wanted to take note of it, down 3.7%. Shares did drop as much as 4.5% earlier. The CFO, Mark Mason, warning that investment banking revenue would fall 50% in the third quarter. Trading revenue would drop in the mid to high single-digit range as well. And then another home builder, Romaine, I know you hit on these earlier today. Lennar down close to 8%. Home builders taking a hit today. Toll Brothers, D.R. Horton turning lower as well. Hotter than expected inflation print could signal, of course, that mortgage rates could go up in the short term, and that would certainly put a dent in what happens.
And of course, we'd be remiss not to point out the real impact of big tech here. Apple and Microsoft posting their biggest one-day losses going back to September of 2020. There's your superlatives there. Apple, Microsoft down 5% a piece here on the day. Amazon down 7%, Meta down 9%, NVIDIA, Alphabet also sliding here on the day.
And in large part, that's because of a more hawkish Federal Reserve. This is the talk of 100 basis points as soon as the next rate hike, which we are looking at next week. This is the talk of a more hawkish Fed that impacts the currency markets, of course, every single market. Cross-asset for our radio audience in the FX space. King dollar, once again, we're up 1.2% on the Bloomberg dollar index. Strength of King dollar means weakness across the board, particularly some of your more emerging market, China-focused currency pairs. I'm looking at New Zealand off by more than 2.3%, Norwegian krone off by 2.7%. Of course, oil being dragged a little bit lower at the moment. The Canadian dollar, the loonie, also weakening by 1.4%. Let's take it over to commodities. Natural gas, really the only area that seems to get a lift today as we march closer to perhaps some of that preservation in Europe of their overall gas, trying to stem the crisis, but it doesn't mean that they'll put a cap on imported gas. We're looking at iron ore off by 0.9% as we worry about a global slowdown and the Fed having to hike too far, too fast. Steel off by 1.5%. We see metals crumble, but soft commodities also rally as we see food concerns becoming front and center. Just think of the inflation print when we look at the food prices overall. And I'm looking at a sovereign bond market that saw money move into the Japanese 5-year, a little bit of a safety trade there, but Canadian yields, Swiss yields, the UK gilt market, all selling off today, Taylor.
You really saw that in full faith and credit as well, not providing the correlation of a classic safe haven, as it actually was, again, a bond market caught off guard again by the big data print that we got at 8:30 a.m. this morning. A 2-year yield that at one point was up 20 basis points on the day still manages to climb up 18 basis points. We are still the highest going back since about October of 2007. So front-end yield curves are really, really high. You had a decent 30-year bond auctions. You're actually seeing 30-year bonds catch a bid, but you're only down 1 basis point. So really no sort of safe haven here within full faith and credit.
And you started off by saying the magic word there, and that was correlation. The idea that you're seeing these sell-offs and everything's selling off. I mean, you really couldn't have hit out in commodities. You couldn't have hit out in gold or Bitcoin or anything else out there, obviously not in treasuries. And then, of course, you take a look at what we saw in the dollar. I guess that was your only haven. And I think David Stubbs over at JP Morgan Private Bank kind of asserted as to exactly why.
And I think yesterday the narrative was stocks rallied as the dollar weakened. Today it flips on its head. And of course, this is a more hawkish tone that we seem to the market more generally. It is, though, let's put it into context. The superlatives are shocking when you're thinking of the worst day sell-off since March 2020. But we've erased basically the last week. September the 6th is basically where we're trading on the S&P at the moment in terms of levels.
And Caroline, one thing that sort of surprised me, I would expect a superlative in volume today. Volume was a little bit above the 30-day average, but remember that's a 30 days that include the summer. But 11.5 billion shares, that's actually below average for the year of about 12 billion. So a bit of a surprise there, Tim, that volume was not stronger than that.
So what does this all mean for the Federal Reserve later this month when the Fed is set to hike interest rates? I mean, bets are being placed on 75 basis points, Taylor, but Larry Summers coming out a little earlier today on Twitter.
Shocking.
And yeah, right. And look, he's been vocal about this. He's now saying that he would favor 100 basis points over 50 basis point hike, and says that he doesn't think there's any substantial probability in the U.S. that this episode can be managed without rates being raised to close to 4%.
My favorite story right now on the terminal, they should do 100 as traders debate the Fed's next rate move. And you have a list of traders here talking about what they will do versus what they should do. That is the disconnect as we push forward to next Wednesday.
Well, I mean, look, I think the last 4 days and really the last couple of weeks were a test of kind of what the people thought the Fed would do or whether they would stand firm. And Powell has made it clear that's what they're going to do. They're in a quiet period now. We're going to find out on Wednesday what is actually in the cards.
And maybe that's enough time for the market to digest, to get comfortable, to start to price it all in. Overall, we do see the volatility, though, creeping back up. We've seen such elevated volatility in the bond market throughout the year. The VIX now at about a 27 handle. That is basically just slightly above where the average is for the year.
And to go back to kind of what started this, of course, with the CPI report this morning. I mean, there's been a lot of great takes on the Bloomberg terminal, kind of about the different components, and we kind of joke about butter prices, but there's a great story now about flour prices and how it's really sort of reverberated through everything. And I don't think you can discount these things. It's fun to joke about it, but at the end of the day, this has a real impact on folks at home, and it's something that I don't know the Fed really can control.
I would also give a plug for today's big take. It's about Latin America and the way that inflation is just roiling many different countries in the region, leading to political
Can we just for a moment? We're worrying about 8.3% here in the U.S. Argentina has more than 70% year-on-year price increase.
Yeah, some really good context. So check that one out.
Well, to be fair, they've had that for like 20 years.
Yeah.
Yeah. I mean, gosh, we spoke to one of the reporters on that earlier today, and there's a quote in there about being a millionaire to be able to afford eggs. So
Remind me to tell you a great story I have about my time in Argentina.
Okay, I will, but we have to go because our time is out.
Right.
That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, and on YouTube. We are going to be back tomorrow, same time, same place. Our coverage continues at Bloomberg.